Hello! Welcome to Capital Sensei. Today we're diving deep into one of the most practical and powerful finance books for the everyday person, Unshakable by the legendary Tony Robbins. We are going to distill the core wisdom of this book into 5 massive, game-changing takeaways. We'll cover why market crashes are not something to fear, but something to embrace. The silent poison of hidden fees that could be devouring your future wealth. And the simple, time-tested strategies that the world's greatest investors use to grow their money steadily, and most importantly, sleep well at night. Whenever we can, we answer questions in the comments. This stuff can get a bit technical, and no question is a bad one. So if something we discuss today sparks a thought, a doubt, or if you have your own story about trying to navigate the world of investing, please share it below. Your experience and your questions build a community where we can all learn from each other and become smarter, more confident investors together. Let's start with the very first and arguably the most important lesson from the book. It's not about numbers or charts. It's about your own mind. The first takeaway is that you must understand that market corrections and crashes are a normal, recurring, and predictable part of the investing journey. They are not a sign that the world is ending. They are a feature, not a bug, of the economic system. Fear is your real enemy, not a volatile market. Think about it. When you see your account balance plummet by 10, 20, or even 30%, what is your gut reaction? It's panic. It's that voice in your head screaming, "Sell, get out now before you lose everything." Tony Robbins argues, with a mountain of evidence, that succumbing to this fear is the single biggest mistake an investor can make. It's what turns a temporary dip into a permanent loss. You only lose money when you sell at the bottom. Let's put some numbers to this. A market correction, which is defined as a drop of at least 10% from a recent high, happens on average about once a year. That's right, it's an annual event. A bear market, which is a more severe drop of 20% or more, historically occurs every 3 to 5 years. These are not rare black swan events. They are the normal rhythm of the market. It's like the seasons. You know winter is coming. You don't panic and sell your house every autumn. You just make sure you have a good coat. The key mindset shift is to see these downturns not as a crisis, but as an opportunity. When the stock market goes on sale, it's the equivalent of your favorite high-end store announcing a 50% off clearance event. The very same high-quality companies, the same valuable assets that you wanted to own yesterday, are now available at a massive discount. The wealthy don't run from these sales. They run towards them with open wallets. This is precisely when fortunes are made. Consider the financial crisis of 2008. It was terrifying. Banks were collapsing. People were losing their jobs, and the headlines were apocalyptic. The market fell by over 50%. Anyone who panicked and sold near the bottom locked in devastating losses and likely missed out on the historic recovery that followed. But the investor who was unshakable, who understood this principle, did one of two things. They either held on, or even better, they kept buying. From the market bottom in March of 2009, the S&P 500 index went on to deliver returns of more than 400% over the next decade. Every dollar invested during that period of peak fear grew into many, many more. The lesson is crystal clear. Economic winter always, eventually, turns into spring. Your job is not to predict the weather, but to be prepared for it and to take advantage of the opportunities it presents. Now, once you've conquered your fear, there's a quieter, more insidious enemy you need to defeat. This brings us to our second huge takeaway. You must become obsessed with minimizing fees. High fees are the silent killer of your investment returns. They are a relentless drag on your portfolio, a parasite that feasts on your future wealth while you're not looking. This is a topic Tony Robbins hammers on relentlessly, and for very good reason. Most people invest through mutual funds, which are managed by professionals who charge a fee for their services. This is called the expense ratio. It might sound tiny, maybe 1%, or 1.5%, or even 2%. You might think, what's 2%? That's nothing. But that's a catastrophic misunderstanding of how compounding works. That isn't 2% of your initial investment. It's 2% of your total assets, year after year after year. Let's run a simple scenario. Imagine two friends, Sarah and Tom. They both start with $25,000 to invest for their retirement in 30 years. Both of them manage to earn an average market return of 8% per year. The only difference is where they invest. Sarah, being savvy, puts her money in a low-cost S&P 500 index fund, which has a tiny expense ratio of, let's say, 0.04%. It's practically free. Tom, on the other hand, goes with a popular, actively managed mutual fund recommended by a traditional broker. This fund has an expense ratio of 1.5%. Still seems small, right? Well, after 30 years, Sarah's portfolio, thanks to the power of compounding with minimal fees, would have grown to approximately $251,000. Not bad at all. Now, what about Tom? That 1.5% fee didn't just cost him a little bit each year. It created a massive drag. Over those same 30 years, his final portfolio value would be only about $164,000. That's a difference of $87,000. Tom effectively paid a third of his potential future wealth to the fund manager. That small fee cost him a luxury car, a down payment on a house, or years of comfortable retirement. It gets even worse. Many funds also have other hidden fees, like front-end loads, where they take a chunk of your money right when you invest, or 12b-1 fees, which are for marketing and distribution. The financial industry has become masters at cloaking these costs in complex jargon. The solution, as advocated in Unshakable, is beautifully simple. Favor low-cost index funds. An index fund doesn't try to beat the market. It just seeks to match the market's performance by holding all the stocks in a particular index. Like the S&P 500, because there's no high-paid genius manager making bets, the costs are incredibly low. And here's the kicker. Study after study has shown that over the long term, the vast majority of those high-cost, actively managed funds fail to even match, let alone beat, the performance of a simple, low-cost index fund. You are often paying more for worse results. Avoiding high fees is one of the easiest and most effective ways to boost your long-term returns. It's the closest thing to a guarantee in the world of investing. So we've learned to control our emotions and slash our costs. What's the next piece of the puzzle? This leads us to the third takeaway, which is a concept that Nobel Prizes have been won for, yet is surprisingly simple to understand. The single most important decision you will make as an investor is your asset allocation. In plain English, this means how you divide your money among different types of investments. This is the heart of diversification. You've all heard the old saying, don't put all your eggs in one basket. That's the essence of asset allocation. But it's more sophisticated than that. It's about intentionally owning a mix of assets that don't all move in the same direction at the same time. The main categories, or asset classes, are things like stocks, which represent ownership in companies, bonds, which are essentially loans to governments or corporations, real estate, and commodities like gold or oil. Why is this mix so crucial? Imagine you only owned stocks. When the stock market is booming, you feel like a genius. But when a bear market hits, your entire portfolio gets hammered. There's nowhere to hide. Now, imagine you also own a significant chunk of high-quality government bonds. During that same stock market crash, investors flock to the safety of bonds. which often causes bond prices to go up. So while one part of your portfolio is down, the other part is stable or even rising, cushioning the blow. Think of it like building a championship sports team. You don't just hire 11-star strikers. You need defenders, midfielders, and a solid goalkeeper. Each player has a different role. Stocks are your strikers. They are there to score points and provide growth. Bonds are your defenders. Their job is to protect your capital and provide stability when the other team attacks. Real estate can provide steady income, like a reliable midfielder. Each plays a critical part in the overall success of the team. Your specific asset allocation, say 60% stocks and 40% bonds, or maybe 70% stocks and 30% bonds, will depend on your age, your financial goals, and your personal tolerance for risk. A younger person with a long time horizon can afford to have a higher allocation to stocks for more growth. Someone nearing retirement will want a larger allocation to bonds to preserve their capital. The beauty of this is that it's what legendary investor Ray Dalio calls the holy grail of investing. Proper diversification allows you to reduce your overall risk without necessarily sacrificing your expected returns. You can smooth out the ride, making it much easier to stay the course during those inevitable market storms we talked about earlier. It's the architectural blueprint for an unshakable portfolio. This might sound a bit abstract, so how do you put it into practice? This brings us to our fourth takeaway, which is a brilliant and practical strategy for implementing your asset allocation: creating a core and explore portfolio. This is a simple, two-bucket approach that gives you the best of both worlds: the safety and reliability of a diversified foundation and a small, controlled space for more adventurous bets. The core is the foundation of your financial house. It should represent the vast majority of your investment capital, somewhere between 85 and 95%. This bucket is all about safety, diversification, and low costs. It's not meant to be exciting. It's meant to be effective. The core is built using the principles we've already discussed: broad, low-cost index funds covering different asset classes. For example, your core portfolio might consist of a U.S. total stock market index fund, an international stock market index fund to give you global exposure, and a high-quality bond index fund. That's it. With just a few simple funds, you can own a piece of thousands of companies and bonds from around the world. This is your rock-solid, get-rich-slowly but surely machine. It's the part of your portfolio that you can count on to grow steadily over decades. Now for the fun part, the Explore bucket. This is the remaining 5 to 15% of your portfolio. This is your designated space to take some calculated risks. This is where you can invest in things that have what is called asymmetric risk reward. This means your potential upside is many times greater than your potential downside. Your downside is limited to the small amount you invest, but the upside could be huge. What goes in the Explore bucket? Maybe it's an individual stock in a company you've researched and believe has massive growth potential. Perhaps it's an investment in a cutting-edge technology sector, like artificial intelligence, biotechnology, or clean energy. For some with a very high risk tolerance, it might even be a tiny allocation to something like cryptocurrencies. The genius of the Core and Explore strategy is psychological. It gives that part of our brain that wants to speculate to pick a winner, a safe and contained sandbox to play in. It prevents you from making the catastrophic mistake of betting your entire life savings on a single, risky idea. If your Explore investments go to zero, it's disappointing, but your core portfolio remains intact and your financial future is secure. But if one of your Explore bets turns into the next Amazon or Tesla, well, that's a life-changing bonus. It's a disciplined way to have both security and a shot at spectacular growth. We have a plan. We've conquered fear. We've minimized fees. We've set our asset allocation, and we've structured it with a Core and Explore approach. There's just one final piece of the puzzle. One last action that automates good behavior and keeps your entire strategy on track. This is our fifth and final takeaway: the power of automatic rebalancing. This sounds technical, but it's one of the most powerful and simple disciplines you can adopt. So what is rebalancing? Let's go back to our asset allocation example. Suppose you decided on a simple 60-40 portfolio, 60% in a stock index fund and 40% in a bond index fund. Now, let's say the stock market has a fantastic year and your stocks go way up in value. At the end of the year, your portfolio might have naturally drifted to become 70% stocks and 30% bonds. You are now overexposed to stocks and more vulnerable to a downturn. Rebalancing is simply the act of selling some of the asset that has performed well and buying more of the asset that has underperformed to get back to your original target percentages. In this case, you would sell 10% of your stocks and use that money to buy more bonds, bringing you back to your desired 60-40 split. You might do this on a set schedule, like once a year on your birthday, or whenever your allocation drifts by more than 5% from its target. Now, why is this so incredibly powerful? Because without even thinking about it, rebalancing forces you to follow the cardinal rule of investing: buy low and sell high. When you sell your stocks after they've had a great run, you are selling high. When you use that money to buy bonds, which have underperformed in comparison, you are buying low. Let's flip the scenario. Imagine the stock market crashes. Your portfolio might drift from 60-40 to 50-50. Your rebalancing discipline now forces you to do what feels emotionally impossible. It forces you to sell some of your safe bonds, which have held their value, and buy more stocks while they are on sale at rock-bottom prices. You are systematically buying low when everyone else is panicking and selling. This is a behavioral hack of the highest order. It removes emotion from the equation and replaces it with a simple, automatic rule. It prevents you from getting too greedy when the market is euphoric and from getting too fearful when the market is terrified. It's the automated pilot that keeps your financial plane flying straight and level through turbulence, ensuring you arrive safely at your destination. It's the final key to making your portfolio truly unshakable. So let's quickly stitch these 5 ideas together to see the whole picture. First, you build your psychological foundation. You accept that market downturns are a normal and recurring opportunity, not a reason to panic. This allows you to stay in the game, which is where all long-term returns are made. Your biggest opponent is the person you see in the mirror every morning, not the market itself. Second, you ruthlessly cut costs. You understand that high fees are a cancer on your wealth, and you choose low-cost, passive index funds as the primary building blocks of your portfolio. This simple choice can add tens or even hundreds of thousands of dollars to your net worth over your lifetime without taking any additional risk. It's the closest thing to free money in finance. Third, you design your blueprint through asset allocation. You don't just throw money at the hot stock of the day. You thoughtfully divide your capital among different asset classes, like stocks, bonds, and real estate, that behave differently in various economic climates. This diversification is your primary defense against the unexpected, smoothing out your returns and protecting your capital. Fourth, you bring that blueprint to life with the core and explore strategy. You build a fortress with the vast majority of your money in your core portfolio, using those safe, diversified, low-cost index funds. This ensures your long-term financial security. Then, with a small, designated portion, your explore portfolio, you can satisfy your urge to take a shot at the next big thing, all without jeopardizing your future. And finally, you maintain your fortress with the discipline of rebalancing. On a regular schedule, you tune up your portfolio, selling what has done well and buying what has lagged. This simple, unemotional act forces you to systematically buy low and sell high, turning market volatility from a source of fear into a source of disciplined profit-taking and strategic purchasing. Each of these takeaways builds on the last, creating a comprehensive, holistic system for building and protecting wealth. It's not about complex algorithms or risky speculation. It's about mastering your own psychology, being ruthlessly efficient about costs, and sticking to a simple, time-tested, and disciplined plan. This is the path that turns the uncertainty of the market into a predictable engine for your financial freedom. It's how you become truly unshakable.